For this example, we're going to look at preparing an income statement and a statement of owner's equity from the adjusted trial balance. So after we prepare traditional journal entries, we then prepared a trial balance, and then we prepared adjusting entries to adjust accounts for the amounts that have been used or that had expired, and then we prepare adjusted trial balance. So the following information that you see here in this paragraph has all the balances in the accounts after adjustments have been made. So the income statement, we remember that on the income statement we have our revenues minus our expenses. And I've already filled it in here for you so we can just talk about where the information came from. Revenues minus expenses, so I had service revenue in the amount of $2,600. Then I list all of my expenses and their amounts, and you'll notice that these are all listed in the left-hand column, whereas the revenue is listed in the right-hand column. Don't confuse on the financial statements with being a debit and a credit column. They're just our calculation columns. So if you only have one revenue, it goes all the way over to the right. But since I have several expenses, I'm going to put them in my pre-calculations column and add all them up and then put their total. So then I have a single step, revenues minus total expenses, gives me my net income. And it is a net income because my revenue, the amount that I brought in, is greater than the amount of money that I spent, so I made money, so I had a net income. If the opposite would have been true, we would then have a net loss. So we prepare our income statement first, and keep in mind from previous assignments we have to do that because we need the net income in order to prepare the statement of owner's equity. So the statement of owner's equity simply tells us that, or summarizes for us, the changes in our owner's equity over a period of time. In this example, we're dealing with a month. It says for the month ended. Okay, so what I'm going to do is start out with my beginning capital, and my beginning capital is November 30th, which would have been my ending capital for November, which would also be my beginning capital for December. Then I add in my net income that I calculate on the income statement above, and I get a subtotal. And then I'm going to subtract out the withdrawals that the owner made in the month of December. So I put less withdrawals, and if you scroll back up here, it tells us there was 350 in withdrawals. So I subtract that out, and I end up with my ending capital balance, which is as of December 31st, 2014, with $9,300.